Okay, we are going to talk about two business organizations, LLCs, limited liability companies, and LLPs, limited liability partnerships. LLCs and LLPs are among the newest hybrid form of business organizations. They were created just within the last couple decades, which may sound old to you, but in the sense of business organizations, these are pretty young. They have the desirable limited liability characteristics of corporations coupled with the desirable tax treatment of partnerships. Therefore, they have a direct flow through of profit and loss, the same way that partnerships do. In a separate podcast, we will talk about securities and why they matter. There are additional regulations related to the issuance and trading of securities. And the law is somewhat mixed on whether an interest in an LLC or LLP is a security. The very general answer is whether the ownership, whether it's called a membership coupled with management duties, in other words, whether the owner is also active in managing a business, it is probably not going to be considered a security. On the other hand, if we're talking about a passive investor who is more like a shareholder in a corporation, in other words, not active in the management of the business, then that interest will probably be considered a security. This is important because of the laws regulating the issuance and trading of securities, which we'll talk about in a separate podcast. LLCs and LLPs are very similar, and I know that in your textbook, the editors have put them in different places. I think that they have LLPs with limited partnerships, and then they have LLCs off on their own. I think this is a very odd way to structure the textbook, and the reason why is because LLCs and LLPs are almost identical, and they're not very similar to limited partnerships, frankly, so I would study them together. The only significant difference between the two of them is that LLPs are available only for licensed professionals. So think about doctors, lawyers, CPAs, architects, dentists, professions that are regulated by the state are subject to a lot more requirements and fiduciary duties to the public than are other businesses. And those additional regulatory requirements are embedded in LLP statutes. But other than that, they're just about the same thing. If you are one of those licensed professionals and you want to create one of these organizations, you can only create an LLP. You can't create an LLC. Now, how do you create one? There are two documents that you generate. The first are the articles which you are going to file with the Secretary of State. And by Secretary of State, I'm referring to the state in which you are organizing. I don't mean the U.S. Secretary of State. The second document that you're creating is the Internal Operating Agreement. The articles are publicly available. They're pretty short. The second operating agreement is much lengthier because this is the real nuts and bolts of how you're going to run this business. It is not publicly available. Capital contributions, in other words, the assets that you would use to start the business, those can be made in cash, property, or services. Services already provided, incidentally, not future services. In other words, it has to be fully paid in. The profits and losses are shared as provided in the agreement. If there's no agreement, most state law provides that they're shared in the same proportions as the members' contributions. Now, here's a caveat. We came up against this problem when we started partnerships. In partnerships, the general rules are governed by whatever the partners agreed to, but if they don't agree to anything or you can't tell what they agreed to, then you use the default state law. That's the same default rule idea that you're going to have with LLCs and LLPs. However, you're going to need to use these default rules much less commonly. The reason why is because with LLCs and LLPs, you can't even create them without generating documents. So it's unlikely that you're going to generate documents when you haven't covered topics like how they share profits and losses. It's much easier to fall into this problem when you create a partnership, though, because you can create a partnership without even realizing you created one in the first place, without writing anything down about what your agreement is. Regardless, I'm going to tell you about the default rules as we go through all this. How about return of capital? In other words, that original investment. Unless there's an agreement otherwise, the return of capital is in the same proportion as what you paid in. Here's an example. Suppose that Travis Melasante and Tina created an LLC with an agreement that Travis and Melasante would contribute $10,000 each and Tina would contribute $20,000. They agreed that profits and losses would be shared equally and that capital return would be proportionate with original capital contributions. In the current fiscal year, the company has netted. In other words, they paid off all their expenses and they have this much money left over, $300,000. How is it distributed? Well, the three of them have an agreement that it will be split equally, so this is easy. There are three of them, they each get $100,000. Assume that now they want to terminate the business and they have $60,000 remaining. How is the capitalization returned? Again, Travis Melasante and Tina have an agreement about this, and the agreement was it would be proportionate with the original capital contributions. Therefore, Tina will get $20,000, Travis and Melasante will get $10,000 each. There will be an additional $20,000 left over. They have agreed to share profits equally, so $20,000 divided by 3, they'll each take a third of that. Assume instead there's $60,000 remaining. They each had $12,000 remaining. In other words, they're not going to get 100% of their contributions back because there's not enough money for it. The original capital contribution was Tina getting half, so she'll get half of $12,000 or $6,000. Travis and Melasante will get a quarter each or $3,000 each. Assume instead that Travis, Melasante, and Tina forgot everything they learned in business law and created their LLC without providing for distributions and capital return. What would be the result in the first two questions? Well, now you have to kick in with the default rules. And under most state law, let's go to question number 1, profits will be distributed in the same proportion as were capital contributions. So if they have $300,000 left over, and Tina paid in 50% of the capitalization, she will make half, or $150,000. Travis and Melasante will split the remaining $150,000 and get $75,000 each. The second question is going to remain the same as in our second hypothetical because their agreement was that profits and losses would be shared in the same proportion as the original contribution. That's also the same as the default rule under most state law, so that won't change. How about voting rights? Voting rights should be proportionate with a member's profit share. So in the previous example, with the three of them each having 1/3 of the profits in their original agreement, they'll each have 1/3 of the voting rights. Unless there's an agreement otherwise, most state law requires that there be unanimous agreement for extraordinary business decisions. An extraordinary business decision is a decision that would basically end the business as it currently exists. That would include terminating a business, merging with another company, completely changing the type of business it is. For those kinds of decisions, you would need unanimity. It is smart when you're creating an LLC or LLP to consider whether you want a unanimous agreement on anything, frankly. If you have a lot of members, and there are LLCs and LLPs that have hundreds of members, I would absolutely recommend that you not require unanimity. You're not going to get 200 people to agree on anything. One person could hold everybody else hostage from going forward. So it's much better to come up with some different kind of rule. Perhaps consider a supermajority, for example, 80% or 67%. You choose the number, but think carefully about whether you want to require unanimous agreement even on extraordinary business decisions. Management rights are governed by the agreement, and LLCs and LLPs are usually divided between member managed or manager managed. Member managed is more like a traditional partnership where management rights follow ownership rights. In other words, everyone who's an owner or member also has the right to manage the business. The latter, manager managed, is when the members have agreed to either hire an outside manager or to elect one or more of the members to manage the business. The second bullet point, all members have a right to vote, and all members have a right to inspect records, in particular financial records. All members have a right to find out what is going on financially, to make sure there's no mismanagement of accounting matters, to make sure they're being paid their fair share. Can you transfer your interest to somebody else? Again, unless the agreement provides otherwise, you cannot do so without unanimous agreement from all members, because you're really putting a new person into the business. You can typically transfer your interest in the company, in other words, your right to receive profits, for example, but that will not substitute in a new member unless everybody agrees. Secondly, and unless there's an agreement otherwise, you may withdraw from the business upon giving them sufficient notice. Unless typically this is something you would put in your agreement. But if you've been dumb enough not to do that, it'll be governed by state statute. A typical statute would be something like 6 months. You need to give the company 6 months notice that you want to withdraw. You need to repay your capital contribution and any profits that may be owed to you. Why 6 months? Why so long? Well, because you want to give the company a chance to see if they can finance paying a member off without having to dissolve the business. It sort of depends on how much that member's share is worth. But you will basically make a company go insolvent if you have to pay out some huge amount of money and they're not that liquid. So we want to give them a fair chance to try to pay someone off and not simply terminate the business. Let's talk about advantages and disadvantages of LLCs and LLPs. Advantages include there's a lot of freedom to set the business up the way you'd like to, both in terms of management rights and financial results. So it is very similar to partnerships in that it is very flexible. This is unlike corporations, which are fairly rigid. For example, how many shares you own determines what your profit is. A second advantage is that all of the members are committed to manage the accounts unless you agree otherwise, and this is unlike limited partnerships. In limited partnerships, if you recall, only general partners can manage the business. The limited partners are passive investors. They may not manage the business. So LLCs and LLPs allow for a lot of the benefits of traditional partnerships. It allows you to participate in running the business. A third advantage of an LLC or LLP is they avoid the regular limitations of Subchapter S corporations. We will be talking about those in a separate podcast, but there are certain legal restrictions on which companies are eligible to elect Subchapter S treatment, and LLCs and LLPs don't have those limitations. So it frees you up from those kinds of restrictions, but you still get to retain the advantageous tax treatment. LLCs and LLPs are especially attractive for new businesses, and they're especially attractive for businesses that have significant tax advantages, for example, real estate and oil exploration. Let me explain both those ideas. LLCs and LLPs are attractive for new businesses because they're flexible, they have limited liability, and they avoid double taxation. Well, if that's true, then why aren't a bunch of old corporations converting to LLCs, which may not have existed when they started their business, but they exist now? So why aren't they converting to become an LLC? I'll tell you why. Suppose that your grandparents created a restaurant and they incorporated because they were concerned about liability risk. Back when they created this business, LLCs didn't exist. A limited partnership wouldn't work because your grandparents were actively managing the business, so instead they incorporated. Now, It's a restaurant chain. It's been very successful. The business is doing really well. Should they convert to an LLC? Probably not. Why? Because they're going to have to end the corporation, dissolve the corporation, terminate the corporation, pay off creditors, pay all the revenue, distribute assets to the shareholders. Who's interested in that distribution? Well, among others, the IRS is. Why? Because if you're among the beneficiaries of that stock, you now have a windfall. You've gotten a huge amount of revenue now because the corporation has paid out all the equity that exists. So you're now going to lose a huge chunk of this equity by paying taxes, even if tomorrow you're planning to roll it over into an LLC. And because of triggering this tax event, you should think twice before you dissolve an existing corporation. How about these businesses with significant tax advantages? And again, real estate and mineral exploration are examples. These businesses can be extremely lucrative, however, they typically have huge upfront costs. In other words, if you're going to start a real estate development company, there's huge capitalization needs upfront, buying the land, developing the land. The same is true with mineral exploration. It's pretty pricey to acquire the land, to do all the testing, to extract oil or other minerals, to see if you even are able to do that. Is this bad? Well, actually, no. Actually, it makes for a pretty attractive investment for really wealthy investors, because everyone wants to make money off of deals, and eventually, hopefully, you'll make a lot of money off of real estate or mineral exploration. But up front, you generate real losses. Losses might actually be attractive to wealthy investors. Why? Because it lets them deduct their losses against other income or revenues. So if you have a lot of money, I hope you have a lot of investments. I hope you're generating a lot of money that way. Anyway, here are some losses you could deduct from that profit that will reduce your tax obligation. However, those industries are typically attractive for passive investors, not people actively interested in running businesses. If so, a limited partnership will work better for you because those are passive investors. You don't want them fooling around with the management of the business. If, on the other hand, you're all active in running the business, then an LLC is much better for you because it permits all of the owners to run the business. Let's talk about disadvantages of LLCs and LLPs. The memberships might constitute a security, as we mentioned earlier. And as we mentioned before, we will talk about securities in a separate podcast. A second disadvantage is that LLCs and LLPs are not the beneficiaries of many of the tax advantages or other laws that currently exist to benefit corporations. Corporations have existed for such a long time, and over all that time, both federally and under state law, there are kinds of schemes that benefit the shareholders or the employees of a corporation or directors or officers of those corporations. I'll give you some examples, although you don't need to know these. I'm just using these by way of example. Stock options. One way that corporations often compensate high-level employees, for example, officers, is to give them stock options. So, for example, let's say you get hired by a corporation. It's working out really well. They want to keep you. They may say something like, "We will give you an option to purchase stock in 3 years at $12 per share." Let's say that the stock is currently trading for $12, but you think the company is going to increase its profitability and that the price of the shares will rise. This gives you an incentive from the company to stay there for at least 3 years so you can exercise that option. Let's suppose that in 3 years, the stock is now trading at $20 per share and you can buy it at $12. Buy it. You just got a huge bonus because you bought something for $12 that you can turn around and sell for $20. Or depending on your tax situation, your financial needs, you may want to delay in doing that. It depends on whether you want to trigger that tax event, but it gives you a lot of money, and it's desirable because it creates incentives for high-level employees to be productive in building the company's growth. There's also different tax treatment of dividends, and that's a nice perk. Again, you don't have to know all of these examples specifically. I'm just kind of giving them to you to let you know that there are some nice benefits that may accrue to corporations that do not accrue to LLCs and LLPs. And ESOP, ESOP, is an employee ownership program. It gives tax benefits to employees to purchase the stock of a corporation. There are also a lot of tax-sheltered compensation plans for employees of corporations. Now, why don't all these incentives exist for employees or employers of LLCs and LLPs? Again, I think it's because they just haven't been around that long to create that history of beneficial legislation. Maybe it will all happen in the future, but for today, you have to consider the fact that you're not going to get the benefits of some of those kinds of legislation. The final significant disadvantage of an LLC or LLP is that it is not available for a one-owner business. You need 2 or more members.